In today's financial landscape, people are constantly searching for reliable and sustainable sources of income. While traditional investment options like bonds and saving accounts may not provide the desired returns, dividend investing has gained significant popularity over the last 10 or so years. Dividend income earned by owning shares of dividend-paying companies can be an effective way to generate passive income. And in this video, we are going to explore the potential of dividend income from a $100,000 investment and reveal some surprising results. Now, the crazy thing about dividend investing is that not all dividend stocks and ETFs are created equal. There's some dividend ETFs like the Schwab US Dividend Equity ETF that starts at only a 3.62% dividend yield, while other ETFs like the JP Morgan Equity Premium Income ETF is yielding around 10.58%. Now stay tuned until the end of this video because we are going to go over multiple different scenarios in which a dividend investor has $100,000 invested in different types of either stocks or ETFs and show you exactly how to calculate everything. Let's establish a basic understanding of dividend income and what it is. So dividends are periodic payments made by companies to their shareholders, typically out of their profits. Now, dividend-paying companies tend to be more stable and mature as they consistently generate excess cash flow, which is then passed on to the shareholders. And by investing into such companies, individuals can enjoy regular income streams from the dividends that they receive. Now let's consider an individual who invested $100,000 in a diversified portfolio of dividend-paying stocks. The goal is to assess the income potential and understand the surprises that might emerge from this specific investment strategy. So the first surprising result from a scenario like this is the significant passive income that can be generated from the example of the $100,000 investment. Now, the dividend yield on the stocks or ETFs within the portfolio is going to be a crucial factor to consider when evaluating the income potential. Assuming an average dividend yield of 3.5%, which is somewhere in the middle of what you're going to find throughout the market. This initial investment of $100,000 in a 3.5% dividend yield is going to generate around $3,500 annually in dividend income. And the way that you calculate dividend annual income is very simple. You just take the total amount invested in whatever stock or ETF it is and multiply that by the current dividend yield. So in this case, $100,000 invested at 3.5% equals $3,500 in annual dividend income per year. Now, one of the more appealing aspects of dividend investing is going to be the potential for dividend growth. And this happens to be my favorite part of dividend investing. Many companies increase their dividend payments year after year, providing investors with a growing income stream. By reinvesting dividends or selecting stocks with a track record of consistent dividend increases, the initial $3,500 can compound significantly. And to see a very simple visual representation of this, if we look at the Schwab US Dividend Equity ETF and look at the dividend history from now all the way back till 2012, you can see that back many years ago, this ETF was paying around 14 cents to 20 cents per share per quarter. And if you were to fast forward around 10 years or so, now this ETF is paying the same exact shareholders that would have purchased into this ETF many years ago around 60, 70 or more cents per share per quarter. So this gives a very obvious representation visually of what dividend growth can look like. And it's obvious that if investors were to just hold on to a high quality ETF that has a history of growing their dividends consistently over time, that investor is going to get paid more and more in the future. But like we said earlier in this video, I want to go through multiple different stocks and ETFs and show you how much dividend income each one of them would distribute to dividend investors on a yearly basis. So first, let's take Apple, for example. Apple's a very high quality dividend growth stock. Now, many investors buy into Apple specifically for the capital appreciation, and as you can see, the stock has appreciated like crazy over just the past few years. But Apple does pay a dividend as well. Apple currently has a forward dividend yield of just 0.5%. So if you were to use the same math and use the $100,000 times 0.5%, an investor that would purchase $100,000 worth of Apple at this given time would only receive around $500 per year in annual dividends. Now, on the other hand, a company like Verizon, for example, Verizon over the past several years has not had anywhere close to the capital appreciation like that of Apple. But Verizon stock is offering a 7.27% forward dividend yield as of right now. So if this investor were to invest $100,000 into Verizon stock, for example, this investor would be receiving around $7,270 per year in annual dividends. Another example, the S&P 500 ETF. one of the tried and true ETFs that investors have been buying into for many years now. The S&P 500 is currently yielding around a 1.5% dividend yield. So an investor that purchased, in theory, $100,000 worth of this ETF, they would receive around $1,500 or so per year. And lastly, if an investor was to buy into something like SVOL, or the Simplified Volatility Premium ETF, this is a newer ETF that offers a massive dividend yield of around 16.91%. If an investor bought into this ETF, they could receive around $16,910 per year. Now, if you're newer to dividend investing, make sure to be careful and never to buy into a certain stock or ETF just because they have a high starting dividend yield. And this is one of the most important things to learn early on in your investing journey, especially when it comes to dividend paying stocks and ETFs. And the reality is that diversification is going to be key when building out your dividend stock portfolio, which in this scenario means that spreading the $100,000 investment across various dividend paying stocks or ETFs, which could be in all different sectors or industries, investors can help mitigate risk and capture opportunities along the way through this diversification. This can also help safeguard them against individual stock underperformances and creates a more stable dividend income stream. An investor told me many years ago to never put all your eggs in one basket. Because think about it, if you have your eggs spread out between multiple, maybe 10, 15, 20 different stocks and ETFs that all have a history of doing pretty well, even if a few of those names underperformed long term, the rest of the portfolio would most likely pick up the slack. So in conclusion, investing $100,000 in dividend paying stocks can yield surprising results when it comes to generating passive income. And again, like we talked about, this is going to completely depend on what the investor chooses to buy into. If the investor chooses to buy into a high yielding ETF, something like JPIE, like we looked at earlier, then obviously the passive income is going to start off much higher compared to an investor buying $100,000 worth of something like Apple. But as we said, just because a stock or ETF yields a higher amount does not mean that it's necessarily a better or worse investment. And of course, diversification can help build a resilient portfolio during any market conditions and volatility. So lastly, I want to hear from you guys down below. If you had $100,000 to invest in the stock market, comment down below the stocks and or ETFs that would make up your dividend growth portfolio. If you enjoyed this video, make sure to please drop a like on the video and subscribe for more content like this in the future. Thanks as always for stopping by, guys, and I'll see you in the next one.